Alpha measures how much an investment, like a stock or a mutual fund, has performed compared to a relevant market benchmark like the Nifty 50 or Sensex. Alpha is often considered a measure of active management skill, as passive investments that simply track a market index are expected to have an alpha close to zero before considering fees and expenses. Skilled investors and fund managers aim to generate positive alpha consistently over time by identifying undervalued securities or capitalizing on market inefficiencies. However, achieving consistent positive alpha is a challenging endeavor, and past alpha is not necessarily indicative of future performance. Alpha could be positive, negative, or zero. A positive alpha indicates that the investment has outperformed the benchmark, whereas negative alpha indicates the underperformance. And alpha close to zero suggests the investment has closely tracked the benchmark's performance. The concept of alpha is closely linked to the capital asset pricing model, CAPM, which posits that an asset's expected return is equal to the risk-free rate plus a market risk premium multiplied by the asset's beta. Alpha in this framework is the difference between the actual return and the expected return predicted by the CAPM. Investors often seek investments with a high alpha as it suggests a greater return for the level of risk taken. However, it is crucial to consider the risk adjusted nature of alpha. A high return might be achieved by taking on excessive risks, which wouldn't necessarily translate to high alpha if the benchmark with similar risk also yielded comparable returns. Therefore, evaluating alpha in conjugation with risk metrics like beta and Sharpe ratio provides a more comprehensive assessment of investment performance. Ultimately, alpha serves as a key metric for evaluating the effectiveness of investment strategies and the skill of those managing the investments.